The correlation between central bank assets and global stocks have continued to persist. This was noted several years ago and still continues to this day. Right now, there are global growth concerns, risk of enhanced tensions, potential catalysts for oil to multiply in price, but none of this matters. The Fed is going to reduce interest rates and keep the party going. Are you ready? You came here for the truth, so let me unveil that for you. Today we are looking at what has happened in the stock market. It is important to track and trace this information as it plays out. We're going to talk about many economic indicators. I'm going to show you the data that you need to know, so let's begin. First, we're going to start by looking at the markets. You can see how aggressive the moves were today, up and down, positive and negative, but ultimately the S&P ended in the positive, about 7 points higher. So we don't know exactly when this bull market will end, but for the foreseeable future, it looks like as long as the Federal Reserve is continuing to be easy, extra easy, then of course we will find that the stocks will love it. This week solidified the fact that the market doesn't need, it doesn't want, it's demanding a rate cut from Powell. I do have a little bit of caution going into the earnings season because we have some forward guidance uncertainty with the trade tensions, but the wind in the sails continues to be that dovish stance from Powell. This is what everybody is hoping for, that the Federal Reserve will keep interest rates low for the foreseeable future, never to bring them up again, never to normalize as they promised to do, never to actually unwind their balance sheet at a normal pace. No. They need to stop that altogether and perhaps even continue to purchase more assets. Well, we've been seeing this going on for 10 years now, and it doesn't seem to be stopping anytime soon. I want you to pay attention to what is going on with the Federal Reserve at all times. We can see that as soon as Powell makes a speech, the market reacts accordingly. Whenever they put out their official statement, you see right at 2 p.m. the market reacts to it before you even have a chance to watch it or to read it. Then they come online and they start talking about the information, and they basically just read a prepared statement and the market reacts again. And this happens to be the case where you will see aggressive moves, all based on words, just words, no actions. If you think about it, what has happened over the last several months? December, they increased interest rates and said that we would still be doing so a few times in 2019. Not only did they not go through that path, but they're actually now considering reducing interest. We'll see if they will actually do this when the meeting happens. The market is absolutely pricing in this at this time, and this to me tells us that we are in for one hell of a ride. If the market doesn't get that rate cut, it is going to absolutely go crazy. Well, I think it will get that rate cut simply because they are not prepared for any other conditions. That's what we're looking at right now. Let me show you some more information here. If you want to understand why the market is increasing or decreasing, you have to understand the global money supply. You need to follow what's happening with the central banks. You need to know what's happening with the expansion of money, the velocity of money. All of these things are so important. Here you can see the green line, and that is the S&P 500. And then you also have the global money supply. And whether you see this on a daily basis, it might fluctuate, but ultimately what we have is that these two go in lockstep with each other, and you will find that over time what we have are central banks increasing the amount of money that they hold. You could see that they are lending out more money in general, the commercial banks. And then you have the S&P 500, the Nasdaq, the Dow Jones. While they do fluctuate on a daily basis, oftentimes they correspond entirely with what happens with central banks. And that's why I had said a long time ago, many times, repeated over and over again, you've been watching here on this channel, that as long as the central banks are willing to destroy the value of the currency, they will in fact print more money, create positive flows into equities, into housing, into any other type of asset, simply because that's what we are doing today. We are devaluing the currencies and watching the prices of everything increase. Tuition is increasing. They didn't necessarily intend on creating that, but it has happened. It has been really a side effect of all of the intervention. This has been going on not just over the last 10 years, but of course it has been accelerating throughout this period. So this is really the key. If you want to know what I said a long while ago, and I had to make this 60-second video in particular, just because I had to repeat myself over and over and over again, I was getting sick of repeating it. So I decided to just create a 60-second video and talk about exactly what's going on. And I will link to it at the very end of this video if you want to see it for yourself. U.S. core consumer inflation tops projections in broad advance. Okay, we're going to talk about this Bloomberg article here. This is where things get a little tricky because you have the Federal Reserve. They claim to be looking at inflation. Of course, they're always looking at the core PCE rate, which is a very fake rate. It has no bearing on reality, but of course, this is what we deal with. They're looking at the unemployment rate, and we see it near all-time historic lows right now. And you have all of the different factors out there. Maybe it's the stock market, maybe anything else, consumer confidence and everything that they have in front of them. Right now, everything according to their stats is completely doing fine. So the question I have is, why are you going to reduce interest rates? Why would you increase interest rates? Why would you decrease them right now? You would think to yourself, this is the time, we'll just leave things the way they are. There's no concern with inflation. There is no problem with the stock market. Unemployment's at a record low. Why in the world wouldn't we just leave things, let it as it ride, and let it just happen? But of course, that's not what we're doing here. We are actually trying to tinker with this system, and they do so at their own peril. The Fed's anticipated rate cut is unusual in that it comes at a time of very low unemployment and an economy that is growing at a trend of about 2%. The economy added a surprisingly strong 224,000 jobs in June, and there was an unexpected pickup in consumer inflation. The core PCI is at 2.1% year over year, one of the highest readings during the recovery. So this is right now, as you can see, that inflation was really muted. We're concerned is too low. Well, in this case, it depends how you measure inflation, but with the core CPI, it's at 2.1%. And that's what they want to see in that case there. There are other measures. And this just shows you that if you're looking at other data, you may come up with different results. That's obvious. It always is like that. But here is just one more example where the Federal Reserve really has no excuse to cut rates at this time. Will they do it? You tell me. Hit me up in the comments section down below. Let me know what you think. And then at the bottom here, they have some really good information I wanted to show you. I've now come to the conclusion the Federal Reserve is going to cut rates not because of the weakness in the US economy, but because they want to make the coordinated effort to forestall a global recession. My question is, with all of this information that you have here, why are you going to cut rates? It doesn't make sense. What exactly are you going to do by cutting rates by a quarter point? Are you really going to forestall a global recession? How is that going to affect you when everything that you've been seeing so far has been positive? Well, something's not adding up. That's really what it comes down to. Fed chairman warns of unthinkable harm. My goodness, if the debt ceiling isn't raised. Can you believe it? The debt ceiling problem. We have this fiasco that occurs every single several months. They come out with the same thing. Oh my goodness, we're at the end here. We can't make a decision. Oh no, what are we going to do? And then they do. They always increase the debt ceiling, even though Obama had said we don't have to worry because increasing the debt ceiling does not increase the debt. You know, that quote. Now, essentially what we have here is the same problem over and over and over again, where more debt is added, the deficits continue to get worse, and the central banks around the world continue to print more money. This cannot, absolutely cannot end well for the average person. This always ends terribly, and you can see that this is the most excessive they have ever gone. We can look at the previous cycles and see that, okay, when there's smaller problems, then the real crisis that is created are smaller smaller in respect to the information that we're getting at today. I mean, when you see the excesses that they've gone into, it is mind-boggling. My goodness. I just want to show you really quickly. Index charted a long and bumpy road to cross its latest 1,000 point milestone. Just wanted to show you the previous times that it was encountering this area here between 26 and 27. I thought it was interesting to see how hard it was to actually cross this. I mean, a year and a half basically trading within this range. Meanwhile, people were saying buy the dip, but it took a year and a half just to be able to cross that point, and it will potentially go higher if the Federal Reserve cuts, if you see the trade deal signed on a paper, not just in some tweet or something. This right here just gives you an idea of how long it could take to break through certain barriers. But I wanted to leave you with this information out of Hussman Funds. He said this: "We learned the hard way in the recent cycle that we can't just assume that there is any limit to speculation. All we can do is to measure those speculative tendencies through market internals and respond accordingly. On the other hand, when divergence and internal deterioration suggests that investors are inclined toward risk aversion, it's dangerous to blindly assume that monetary easing has some magical power to support the market." Remember what happened in 2007. We saw these same behaviors. People were talking as if nothing bad could ever happen. Don't worry, Federal Reserve has got it. The government is going to print money. They're going to fix it up. They're going to make sure it's all good. But then we still had 2008. We still had the housing crisis. We still had mass job layoffs. We still had a stock market that came down tremendously. All of this was at the time that the Federal Reserve was dropping interest rates, and this happened to be a problem for a lot of people not in the financial industry but going all around the world, in fact, that were feeling the effects of this, that they did not act appropriately to interest rates in the first place. Then they had to try to save face. Oh no, there's no problem right now. Don't worry about it. No problem. And then they always react too late, and they're doing it too slowly, and then you have the problems that we have today. The same situation essentially. I'm going to end the video there. If you found it informative, please hit that thumbs up button. When you give me a like, you are supporting me and this channel. I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need, all the details from A to Z, the foundation, the history, the asset classes. Definitely check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to see that 60-second video where I talk about what will happen in the stock market, up or down, you gotta watch it 60 seconds. Click on it and I will see you there.